Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to IFA.TV. Today we have a special treat. We have Joe Chi, the co-head of Portfolio Management and Vice President at Dimensional Fund Advisors. Joe's going to talk about a very important topic called corporate governance. This has become increasingly important as we see more and more investments move into index fund or passive managed types of funds. Companies like Vanguard, Dimensional, BlackRock, and State Street are becoming large shareholders of many corporations around the world. And so how they handle the important topic of corporate governance is important for you. We have Joe Chi was the previous chairman of the Corporate Governance Committee at Dimensional Fund Advisors, and now he is still a member of that committee. So he's an excellent person to explain this topic to you. Joe, take it away.
Thank you, Mark. And thanks again for the opportunity to come back here and present on corporate governance at Dimensional. This is a topic which I know many of us are hearing more and more about in the media. It seems like every day there's some new issue on corporate governance that's been widely played in the print and in the news media. And the question we have to ask ourselves is, just because the media cares about corporate governance, should we as investment managers care about corporate governance? The answer is a resounding yes. So today we'll talk about what corporate governance is. We'll also talk about how we do this at Dimensional Fund Advisors. And then we'll provide some examples of things that we've actually done from the corporate governance in terms of talking to companies and how our actions have influenced positive changes in governance. So the first thing is to ask, what is corporate governance? We like to think of it in three ways: giving shareholders a voice, oversight of leadership, and aligning management in shareholder interests. Now, many, many years ago, this wasn't that important. Many years ago, companies were quite small. Many of them were sole proprietorships. So if you owned the company and you didn't run the company well, or if you tried to steal from the company, you were really just hurting yourself. Fast forward to today's age of many multinational companies, hundreds of thousands of employees, thousands of managers. It's very hard to actually know what's going on a given day. So what does an individual shareholder do? An individual shareholder appoints agents for them to act in their best interests, to oversee the company. Typically, you find that in the form of a board of directors. So you'll find that shareholders typically vote for boards of directors, and these directors are responsible for ensuring that shareholder interests are looked after. So going back to the first point on this slide, giving shareholders a voice. Corporate governance includes the practice of giving shareholders a voice in how the corporation is run, and that is through, usually in today's day and age in public companies, through the board of directors. But that said, you can't just leave your board of directors doing what they want to do without oversight. We'd like to think that people want to do the right thing, but at the end of the day, if you don't have oversight of the people that you've appointed, you can run afoul of issues. Those issues come up when you have conflicts of interest. So this very last point, alignment of management and shareholder interests, covers that. So again, corporate governance is important. It's something that we do at Dimensional, and it's something that we're uniquely positioned to do because we're very long-term shareholders, and we're very large shareholders in many companies. What that gives us the ability to do is to vote often and vote for a long period of time on how companies are run. Now, just because we can, how does that influence you as an investor? Well, I'm going to go back to a concept that we've talked about many times in other presentations, and that is that stock price is driven by discount rates and expected cash flow. The higher the cash flow, typically the higher the price of a stock. The lower the discount rate, typically the higher the price of the stock. I'd like to tell you that corporate governance can influence both, and I'll provide some examples. On this slide, you'll see that cash flows can go out of the corporation in many ways. Some are to vendors, other suppliers. They can go in the form of dividends or other distributions to shareholders, or they can go to management. And all of that's normal. The question is, are some of those cash flows necessary? For instance, if you have excessive compensation going to management, that is essentially transferring wealth from shareholders to management. Another thing is if management tries to impede potential acquisitions or transactions that are accretive to companies, that also is a form of taking shareholder wealth for themselves. On this last point, we'll provide some examples later on. But I think it's important to note that one of the things that you can think about is, you know, that Dimensional focuses on the size premium, and we do that from an investment standpoint. Some of that small cap premium that we see is driven by accretive M&A activity. So we don't want to let management inhibit that, and we'll talk about why they have incentives sometimes to do that and how we address those situations. Now, discount rate's a bit harder to quantify, but let me put it to you this way. Let's say you have two companies. They're equally situated, except that one management team is much better than the other. They're much more qualified, they don't have conflicts of interest, they have a better track record. All things being equal, in other cases, the company that has better governance and management should be expected to have a higher valuation. So for us, this means that we should do what we can to improve management and the governance because that will result in a higher stock price. So that's another area that we focus on as well. In short, we do believe governance is important to shareholders, and we do believe it can impact both the numerator, cash flows, and the denominator, discount rates, which does show up in returns.